to read you a Warren Buffett quote. I figured that'd be a good way to start this off. We're going to talk about some current, the high frequency data. We're going to talk about the issue that's driving all this, and we're going to talk about some longer dated data, and to kind of combat the conversations we're seeing in the media about, and some of the volatility that's out there right now that we're seeing again. But we want to talk about what's really happening in the economy, look at real data, not draw projections off that data, but just look at what's happening first and start with that. So to kick off here, I wanted to read this quote. It's not a short quote, but I think it's a really important quote because this is kind of how we view operating in markets. And I'm sure no one on the call besides me knew this quote was coming. So there may be I may get some feedback. I see David's already grinning. So we'll do this here. This is Warren Buffett. This is from the 1987 Berkshire Hathaway annual letter. And he says, you should imagine market quotations as coming from a remarkably accommodating fellow named Mr. Market, who is your partner in a private business. Now, without fail, Mr. Market appears every single day and names a price at which he will either buy your interest from you or sell you his interest. Now, even though the business that the two of you own together may have stable economic characteristics, Mr. Market's quotations will be anything but. For, sad to say, the poor fellow has incurable emotional problems. At times, he feels euphoric and can see only the favorable factors, the positive things affecting the business. And when he's in that mood, he names you a very high buy-sell price because he fears that you're going to buy his stuff up and rob him of imminent gains. At other times, he is depressed and can see nothing but trouble ahead for both the business and the world. On these occasions, he will name a very, very low price since he is terrified that you're going to unload your interest on him. Mr. Market has another endearing characteristic. He doesn't mind being ignored, and you never have to trade with him. The advice that I think is embedded in this is that the best way to deal with Mr. Market is to ignore him most of the time. You only really need to check prices when you have to buy something or sell something. And and this goes to our process, if you realize that by being planning-based, asset allocated, always being diversified and rebalancing, then whenever you do have that need to buy or sell, you can be flexible as to the thing you buy or sell. Some things are going to be lower, some things are going to be higher, and we can be flexible on what you choose to buy or sell to fill whatever the need is that day. And that's important because we are seeing volatility come back. And we're seeing the last few weeks have seen an uptick in illness, and that's coincided with an uptick in volatility. And for the last many weeks, we've had these conversations. We've talked about the idea that we're going to be playing whack-a-mole with this virus. We're going to open up, and we're going to see more cases, and we're going to have to slow down again. And then when we slow down again, we're going to see those cases come under control. And then we're going to be, confident, and then we're going to be opening up again. And so in the last couple of weeks, we've seen New York and Connecticut and New Jersey and Massachusetts all have a leveling and a reducing level of infections, hospitalizations, and deaths. And in the Sun Belt and out west, we've seen higher numbers again. We're not immune to this. I was at a soccer thing last Sunday, and I was there with my brother and our two eldest sons. We were kicking the soccer ball around, and two entire teams showed up with refs, with fans, with no social distancing, full contact soccer games, and this was in Orinda. So this is not something we are not being smart about this stuff by and large, and so we're going to see a little bit more infections. Now, we were making progress as a nation, but being human, we got a little bit overconfident and the progress has turned over. We've seen the highest infection dates or highest numbers of infections on individual days to date in the last few days. And we're going to see more of this. And the longer this persists, the greater the economic damage. The greater the economic damage, the longer it's going to take for the recovery. It doesn't mean that we won't have a recovery. It just means it's going to take a longer period of time. Now, I'm going to use that as an intro. And before we get into some data, I'm going to see if Scott switched over, then happy to entertain Scott having a conversation. John or David, if you guys have anything to add, please, this would be a good time to interject before we go into some data.
I'll add that Warren Buffett, a couple of months ago when he had his meeting, told the same story.
Did he really? Again?
Yeah, it wasn't Mr. Market though. It was a farmer who buys a farm next to another farmer, and that farmer constantly visits the new farmer saying, gee, I think I should buy your land. And then the next day, I think you should buy my land, or what do you think it's worth? And just back every single day, badgering the poor new farmer who all he wants to do is farm and raise crops.
So the idea is ignore your neighbor trying to buy and sell your land every single day.
Yeah.
Same story. I think Scott's actually working now, probably.
Maybe not. Hold on.
The backdrop isn't working.
It's not going to work. Yep. That's fine.
So I'm gonna get into some data here. We've every other week or every week or so, we've actually talked about this information, which is the high frequency indicators. And we've looked at 6 different things. And there's actually a lot of these, and I'm going to go through a whole bunch of things. This is a list of things, all of which is really, really bad when you look at year over year. So we have to remember that March and April, and to some extent May, were rough, very rough months. But since we bottomed out, and this was probably April timeframe, in terms of all the numbers, economic numbers and market numbers, things have been improving. And this is a list of things that are positive, whether you look at them month over month or week over week. So initial jobless claims, there's still people losing their jobs, but the number of people losing their jobs has been coming down every week for many, many weeks. Continuing jobless claims also coming down. So people that are unemployed for a long period of time, that number is coming down. It's still very high, but it's coming down. The staffing indices, the weekly retail sales numbers, actually box office receipts are starting to show some signs of life. Very minor signs of life, but some signs of life. Rail car traffic, steel production, hotel occupancy, the actual price of hotel rooms, hotel revenue per available room. Open table, we saw Open Table got really, really good about a week ago, and that's actually come off. It's still better on a month over month and a week over week basis, but only a little bit, because I think that's been one of the big questions that is creating higher rates of infection, is people going out to restaurants and not keeping their distances. TSA checkpoints, the gasoline sales, these are all things that are positive on a month over month and a week over week basis. And this kind of flies in the face of this new volatility. And I think some of the reasons for the new volatility are the fear that we return to everything being locked down again. And can't say it won't happen. Can't say it's not going to happen. I think that there's a higher reliance upon people making decisions for themselves rather than being forced to make the decisions. And I think that reliance early on has led to a higher infection rate. But we've also seen the infections in some of the more red states have caught up with some of the more densely populated blue states. And I think that we may see that people learn from this. I hope we see that people learn from this. I know that some folks on the call will argue that some people can't be taught. David, what do you think?
Some people can't be taught.
Okay.
Well, they have an ideological reason not to act in their own interest.
Yeah. So Dave and I, we kind of go back and forth on this a little bit from time to time. I think that, yes.
I'm just laughing.
Okay. Yeah.
It's funny.
I wouldn't say we argue about it, but I do think that when people don't see the infections come around them, we have to remember that in the blue states, in California and New York, we saw a lot of infection early, whereas in some of the redder states, they did not see a lot of infection early. And now they're seeing that infection, and now they're starting to lock down, and we saw them slow down on the opening process, and we've seen some of those decisions come down. I think likely we will still maintain control of the infections, the numbers of infections, because people are largely self-aware. They largely want to take care of themselves and not get sick. We have this conversation in my own house because my kids want to go do more than I think is probably smart. My wife and I had a little argument yesterday about whether it makes sense if El Cerrito opens the pool, which it looks like El Cerrito pool is going to open relatively soon. Should she go swimming? I don't think she should, but they're opening and they're taking precautions, one person per lane, all those kinds of things. Maybe that's enough. I don't know. But I think we will see a continuing increase of infections. But let's talk about some of the slower data. There's some good things and some bad things in the slower data. Last month, durable goods orders. These are washing machines and refrigerators and the durable goods out there rose about 16%. New home sales were well above expectations. Chicago Fed's National Activity Index improved dramatically. The Purchasing Managers Index rose. One of the big concerns we've had was that we'd have disinflation, and because that Purchasing Managers Index rose, it kind of took away some of the edge on that possibility. Second quarter GDP expectations are increasing, not decreasing. For a while, they were, people said, it was going to be really, really bad, 6 or 7% on the quarter, which meant, 33, and it got as bad as an expectation of a negative 50% year over year, not year over year, but on an annualized basis. That's actually improved. Now some of the expectations are more than 33 or 40%. Now that's the good. The bad, existing home sales fell about 10% month over month. So that just means that continues the decline from the prior months. And this is maybe a good, maybe a bad. First quarter GDP was left unrevised. So they said first quarter GDP was down 5%, and that was left on the second issuance of it. And then the expectations, this is bad, of second quarter are still bad. Even though they're getting better, they're still very, very bad. Now, there's a lot of talk about, and we're going to see a lot more talk about in the next 4 weeks, we're going to see a lot of talk around whether we're going to see continuing support from Congress, fiscal support, additional fiscal relief. And I don't want to call it stimulus at this point, because there's nothing to stimulate. It's relief. And so the question is, will unemployment benefits be extended? Will additional, or continuation of PPP benefits, will we have more business programs? Will there be additional state support? And I think that there's going to be a lot of argument. There's going to be a lot of fighting. There's going to be a lot of stuff. But ultimately, we will see, in all three categories, we will see an extension of benefits. Probably a reduction in the overall benefit for unemployment benefits, but I think we will see an extension. Not the $600 a week. Maybe it's $400 a week. Maybe it's $300 a week. But we're going to see something, because these 20 million people that are continuing to be unemployed, they cannot go back to work because those businesses are either gone or unable to open because of the virus. And because of that, we're going to see more federal fiscal relief. I keep falling into the the phrasing of stimulus, and it's not stimulus, it's relief at this point. We will get to stimulus in the future, but right now it's just relief. So that's the data. That's my expectation regarding fiscal relief. I think the Fed is already doing everything they can possibly do, and all their language is to say that there's no reason that they'd be thinking about changing anything. But I wanted to leave it there for a second and see if David or Scott or John wanted to add anything there. There aren't any questions in the Q&A, but we have some questions, I think, pre-prepared, just in case. Gentlemen?
Well, I think that was a good gloss, Jonathan, but I have less confidence, actually, that the Republicans are going to come through on this with regard to, re-upping continued support for unemployment, things of that sort. I mean, it seems perfectly logical that they have to, but they've been resisting doing a lot of things that would seem to be perfectly reasonable and necessary. So, you look at the infection rate in Florida now. On May 20th, Ron DeSantis made this huge public statement saying, well, we're just fine, and they've told us we should be sheltering in place. We didn't, and we're doing great. Well, he hasn't come out and repeated that at this point, but, they're still talking about holding the Republican convention in Jackson in August. I mean, it's completely nuts. So I just don't have an equivalent confidence at this point. Obviously, the pressure is going to increase. So,
and their states are at risk. Like, I think there needs to be they will all fight for additional state stimulus. And in order to get the state stimulus, the more progressive of the states will say, okay, but you have to extend unemployment. I mean, I think the reality is what we've seen, and this started in 2008. In 2008, the idea of just massive spending and massive Fed effort was argued. It was discussed. This is stupid. We can't do this. Unintended consequences. And now we are 12 years later, and the minute this happened, we had $3 trillion of spending, like within a month. And they are
I totally
reticent. They're less
I agree with you about that, but tomorrow is June 30th. It's the end of the fiscal year for most states and municipalities. And it's clear that for those entities, a majority of which have legal necessities to balance budgets, the only relief for that would have had to come from Congress, and they have done nothing about that. So we are going to start to see possible
cracks.
Defaults on municipal bonds and other kinds of things that clearly should have been avoided by federal help, but they've resisted doing it. So.
Yep. Scott, I noticed you demuted.
How's the sound? Is it okay?
Yeah, it is.
Good. So I actually think it's really important to focus on the things you were saying earlier. The hotel occupancy, which was once basically zero, and now it's almost half. It's almost 50% of occupancy. Restaurant bookings, which were basically also zero just a few months ago, and it looked like Armageddon, are about 40% of where they once were. That's a tremendous amount of progress. And guys, this has only been like 100 days from the bottom. We're not having this conversation 3 years later. When are we recovering? It hasn't been a whole lot of time to digest. And so I think there's a lot of even air travel, which was basically almost zero, is about 30% off of that bottom. So it's back to 30% capacity and increasing. But the most impressive thing I think out of all this, which you may have touched on earlier, I know John Madden's talked about it a little bit, is this housing stuff. I mean, home sales are literally up 44% from where they were, which is apparently the largest move we've had since 2001 when they started following this index. So people who thought housing was going to fall off, I mean, that at least looks like a really bad call, right? Housing's holding up extremely well. And even mortgage applications are up 20% year over year. So there's a lot of really good things going on, a lot of good underpinnings. Don't get me wrong. I still know there's a lot to digest, lots wrong that needs improvement. If we just remember that when these downturns happen, they generally last about 16 months. We're 3 months in. And so to expect a whole lot of like repair in 3 months, I think is not looking at the evidence. Go back to 1926, these things generally last about 16 months. And so I'm really optimistic 3 months in that we're starting to work through what was a really scary time in March.
Yeah, I think that one of the pieces that that we hear, and there's no questions in the Q&A or the chat, so I'm just going to touch on something that we've heard. We're talking about the economics of it, and everything you're talking about, Scott, is great. Things are getting better and better and better in lots of places than they were a month ago, than they were a week ago.
Yep.
The question I'm hearing a lot, and maybe you want to touch on this really quickly, is it seems that maybe the market's gotten ahead of itself in terms of its recovery. And obviously we're not predicting what the market does in the next 3 to 6 months. But what do we do if the markets, kind of go back down a little bit? They're off 5 or 6% on the year. We've had a lot of volatility those last couple of weeks. What do we do if markets do kind of start to retrench?
Well, it depends on how far down it goes.
And it also depends, to John's point, it also depends on what markets are you talking about, Jonathan? Are we talking about the Dow? Are we talking about the Morval in Argentina or the CAC in France? I mean, we're global investors for our clients. And so I think we're still, as clients, as consumers, as colleagues, I still think we talk way too much about the US. And there's a whole world out there that we're invested in. And quite frankly, there's a lot of countries, including the EU, that don't want us traveling there because we're currently the mess. So those, for the first time in a very, very long time, there may be an economy where a lot of the world does well while we don't. And no one's even talking about that. So, I mean, I think we could definitely retrench. I mean, that's normal. That retracement's very normal in history. That wouldn't change our long-term outlook.
Right.
At all.
And there's no way to know if we do or don't. And so there's a lot of folks that are saying, let's take some chips off the table. And we're sort of advising that we have a broadly diversified portfolio. To your point, what market are we talking about?
That's right.
Everyone's portfolio has an appropriate level of equity exposure and an appropriate level of ballast.
Sure.
And so if, and this goes back to Warren Buffett's quote, if we have a retrenchment and a retracement and stocks kind of go down a little bit more, maybe they go all the way down to where they were in March. Maybe they don't. Maybe they never go down again. We can't predict that. But if they do, and people need money in that short-term period, they have access to that money in the cash positions in their portfolios and in the fixed income in their portfolios. They don't have to sell stocks if they need money in the next 2 months or so. And so part of the portfolio design and part of the planning-oriented process that we follow is building portfolios that you have access to capital in, regardless of what happens in markets. And I think that remains true today. Guys, have you heard any questions in your conversations with clients in the last few days that you want to touch on?
Well, yeah, I just had one today, half an hour ago. Should I take some something off the table and put it aside? And I'm like, well, it depends. Have you lost your job? No, I'm doing fantastic. Do you have money in the bank? Yes. What about taxes? They're kind of high, but I'll probably be able to pay for them without coming to you guys. So the so-called flight to safety is fraught with question marks, potholes. It's not as safe as it seems. So if everything is working for you, as a family or as an individual, why take something off the table unless there's an emergency out there? You know, globally diversified, that rebalancing, asset allocation, that's your best offense and defense, depending. Market goes skyrocketing, what do? Rebalance. The market tanks, what do? Rebalance.
Yep.
That's what we do.
Yep.
Maybe realize some tax losses as well. Yeah, absolutely.
Well, I think it's useful to finish that. When you rebalance and the market's high, you're selling that part of your portfolio that has increased in value, and you're moving back to your regular allocation. So you're able to sell high. What are we doing when markets are low and you're rebalancing? Is you're buying low because the equity portion of your portfolio is diminished. So I think it's good to remind people exactly what's happening when those rebalancings occur and why that's the prudent way to go forward.
Yeah, you take off the guesswork. You take off prognostication or prediction because.
Well, the important thing I think is too, you're taking the emotion out of the decision making.
Yep.
There is an interesting article in the Times. I'm not sure when it came out. It may have been over the weekend, but it's called sorry, I have to get back. Your 5-step guide to navigating a scary stock market. And the first step is give yourself a break, meaning when you get emotionally overwrought, and there's I don't know if you can see it, but there's oh no, you can't see it, but it's got a little box in there with the word money equals feelings. And so the whole first section of it is talking about the emotion that occurs when the market starts to move in a volatile fashion. And fear is the greatest motivator of bad decision making.
Yeah, and the fear actually trades off. And this is one of the, in some of my discussions in the last couple of weeks with clients who are asking the question that John just posed, do we take some off the table? I tried to explain that there's right now there's a fear of what I put down, a fear of like a tail risk. There's a fear of the market continuing down in response to a negative economic thing. But the very minute you sell, when there's a tail risk fear, the next fear that enters the place is the fear of missing out, is the fear of what if it goes up without me now? And what David was talking about in this whole idea of maintaining a portfolio and rebalancing and taking that emotion off the table is this sort of an implicit recognition that you have to choose your fear, because the minute one fear is gone, then the other fear enters. You are always trading between the fear of some risk and the fear of missing out. And those two things drive so many investor decisions. And I don't know if you read this, you guys read this, but there's been a couple articles that Fidelity, like 30% of Fidelity clients sold their equity positions in March and April. I don't know if they bought them back. The study was not about, it was, they saw this as, really, really cataclysmic, and 30% of the folks at Fidelity sold out huge portions of their equities, which means they probably haven't recovered. And now they're wondering, they're asking themselves the question, do I wait? Do I get in now after it's already gone up another 25, 30%, or do I wait for it to come down again and worry that it never will? And those questions cannot be answered rationally. It's impossible to do it. And that's why we stay invested.
It's also an illusion that we're immune from the emotion
Oh,
relative to the market. We aren't as professionals, but we have our discipline to keep us from inappropriate activity because of those emotions.
right.
And as long as we stick to our own discipline, we come out fine.
That's right. I feel it, but I don't act on that feeling.
Right.
You guys, Scott, have you run into any questions that you wanted to repeat here, just to make sure we get them out there so people can hear them?
I mean, I think we're talking about them. The idea that I feel like, I've heard this from people, they feel as if this spike in cases is going to really hurt the market. And I even heard language like, I'd rather get out of some stuff now and buy it back in a few months. Is just, creating tax consequences to hope that you get the timing right is like just a recipe for really bad outcomes. And so, a spike in cases does not portend lower prices and values. It just means a spike in cases. They may or may not bring the market down. Each and every time we've had these downs with these spikes in the last couple of weeks, we had an 1,800 point down day a couple of weeks ago. We were greeted with buying that came in after that. So you can't, what they've said for 25 years I've been doing this is you don't fight the tape. Since March, trying to get short this market or think the market's going to go lower has been a horrific way of looking at it. The market has been progressively going up ever since that 30-40% drop. And I say this to my dad a lot because he doesn't really, he hears it. I don't know if he actually hears it. But I said to him, Dad, if you look back on all these traumas that we've had, whether it was September 11th, the terrorist attack, or the dot-com, tech bubble, or 87 crash, or even 2008, did you ever notice that there's not like a tech bubble and then like a second tech bubble? It just happens. And then you have this horrible down recession, and then you expand again. There was an 87 crash and then not a second 87 crash. So I think people are so caught up with this drop we just had, but history and the evidence doesn't support a second drop like that, right? It doesn't. 2008 happened, but then it didn't happen a second time, not for 12 years, and when COVID happened. So it's nothing substantial saying you have a 30-40% drop, you take a breath, and then that happens again. Going back maybe to like 1926. But in the middle of it all, I think the pain that we're all experiencing, this all happened in the last couple of months, is you're waiting for some other shoe to drop. And I think that's just the amygdala kicked in with fight or flight. I mean, I think we're all going through this right now.
Yep. John, you hear any other questions?
No, that's really been about it. That's the main one.
So I got into it with one client in sort of a, how do you determine long-term value? Was a question of, something to the extent, something like, we had a conversation about discount models. And so we've heard a lot about, our equities ahead of themselves, not just in the last 3 months, but in general, like in the last couple of years. And one of the answers to that question have always been, well, how do you value the company's earnings? I mean, the reality is stocks are up because earnings are up. And if earnings come down, or there's a question about future earnings, then you see stock prices adjust to that question. And if you look forward 2 years, 3 years, 4 years, I don't know how long it's going to be till we have a vaccine, but we are going to have a vaccine at some point. And when we have the vaccine and we're all free to move about the cabin again and do the things that we did before, there's a ton of media, a ton of discussion about some of the things we're going to do differently permanently. But there's probably going to be a way less permanent change than we anticipate in the middle of this. We're all going to go out and sit in restaurants. We're all going to go out and do these things we've always done before.
100%.
When we go and behave in that way and continue back to doing what we were doing before, companies' earnings are going to return to what they were before. And so if you discount future earnings, the interesting thing is the way you value those things is you discount them usually by some kind of a risk-free rate of return. And today, the risk-free rate of return is damn near zero. There is no risk-free rate of return. And it's very, very, very low. The 10-year treasury is sub 1%. And if the 10-year treasury is sub 1%, then growing earnings is way, way more valuable than a treasury. It's incredibly valuable to have a company that pays a 2% dividend and you get all the upside of that company's growth without, and you get to combat inflation. You get all these positives come from that. So the reason you see what looks like overvaluation is just prices being higher, but that price has to be relative to something, and that price relative to earnings, it's high relative to history, but not when you look at the discount rates. The discount rates are so low that you end up having something as a reasonable price when prices are higher. That's a conversation we had, I think, in January. It's a conversation we had a little bit in last July. But that's one of the reasons you see stocks prices as high as they are. Earnings are up. The discount of those earnings is actually way, way, way down. And so we can kind of justify higher valuations in general. Still anticipate that we're going to see lots of volatility. We're going to see lots more zigs and zags because we're going to be responding to disease and infection. It's going to be a lot of unknowns, and we're not going to know the outcomes. But those of us who believe that, or the way we behave is we actually buy stuff and we are actually engaged in the economy, and I believe that continues, then I think that most of these things right themselves. Commercial real estate might have a tough go. There may be some issues that change things, but it's not going to be the consumer durables or consumer staples that are the ones that are hurt long term. Technology is going to be fine long term. Banking is going to be fine long term. And that's kind of the stance we have, is we believe that these things right themselves over time. And if there aren't other comments or other questions, I think we can, about 3 minutes early, we can close it. I just want to ask to make sure attendees have a chance to ask questions either in the Q&A box or the chat box. But if there aren't any, I think we can close it for this time.
Okay.
Very good.
Anything else, panelists? Nope.
Yeah, I would just remind everybody that which we keep talking about, global, and not to focus on the problems in the United States when half the portfolios are overseas. And you guys may recall, the lost decade, right? After the tech bubble, 2001 and 2, and then 2008. If you had money in the U.S. that whole 10 years, you basically didn't make a whole lot of money. Yet if you were in the IFA or diversified portfolio overseas, you made like 60%. So I think there's this forgotten value in having a global and international portfolio because it hasn't been popular. And I would not be surprised, although I'm not making a forecast, the next several to 10 years, international actually starts to maybe outperform while we work through some of the stuff that we haven't had to deal with in a long time as a country. But
thanks, guys.
Yeah, thank you.
Thanks, guys.
Yep.
All right. See you guys next time.
Later.